What are stocks? Imagine someone who wants to start a business. They have an idea, a plan, and motivation. What they don't have is money. Starting a business costs cash, and not everyone has it up front. So instead of taking out a loan, this person does something different. They go to other people and say, "Help me fund this business, and in return, you'll own a small part of it." Each person who contributes money receives a piece of ownership in the company. That piece is called a stock. When you buy a stock, you're not just betting on a company. You're becoming a partial owner of it. Why people buy stocks? If the business grows and becomes more profitable, the value of that ownership usually increases. Some companies also share part of their profits with owners. These payments are called dividends. Not all companies pay them, but when they do, stockholders receive a portion. So investors can benefit in two ways. 1. The stock becomes more valuable over time. 2. The company pays dividends. Stocks versus shares. People often use the words stocks and shares interchangeably, but they aren't exactly the same. A stock refers to ownership in a company overall. A share is a single unit of that ownership. If a company is divided into 1 million shares and you own 1,000 of them, you own a small percentage of that company. More shares means a larger ownership stake. Different types of stocks. Not all companies are alike, and neither are their stocks. Large established companies tend to grow slowly but are more stable. These are often called blue-chip stocks. Smaller or newer companies can grow faster, but they come with higher risk. Their stock prices can change dramatically in a short period of time. The stock market. The stock market is where people buy and sell stocks. Prices change constantly based on supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell than buy, the price goes down. When the overall market is rising, it's called a bull market. When prices are falling across the market, it's called a bear market. Funds investing in many companies at once. Instead of buying stock in just one company, some people invest in funds. A fund is a collection of many different stocks grouped together. For example, some funds track hundreds of large companies across different industries. When you invest in a fund, you own small pieces of all the companies inside it. This can reduce risk compared to investing in a single stock. Hedge funds. Hedge funds are another type of investment fund, but they are more complex and riskier. They use advanced strategies and are typically only available to wealthy or institutional investors. While they can generate high returns, they can also lead to large losses. Why stock prices change? Stock prices move for many reasons. A company growing, releasing a successful product, or reporting strong earnings can push prices up. Poor performance, bad news, or economic problems can push prices down. Sometimes prices move simply because expectations change, even before anything actually happens. One important reminder. This explanation is for educational purposes only. It is not financial advice, and it should not be used as the sole basis for making investment decisions.